Welcome back to AM Northwest. If the recent stock market volatility has you worried about your retirement savings, you're really not alone. Here with important information, we welcome back financial planning and consulting specialist David Swanson. Always good to see you. And you've been all over the news recently.
Yes.
Because of last week was crazy, wasn't it?
It was, yes.
Absolutely.
Yeah.
So let's talk about it, because a lot of people are concerned if they're at retirement age or living at retirement now, they're concerned about their retirement savings.
Right. And there's a great article today in the Wall Street Journal about the 4% rule. And this is a policy that people have had in place for decades. And it basically said that no matter how your money's invested, just take about 4% every year and you're going to be fine. Your money should last about 30 years based on that.
Only use 4% of what you
just
have.
take about 4% of your account value every year and you're about right. That's called Monte Carlo simulation method, and it's what's used by most major companies in figuring out how much income you should draw off your account. Well, the article talks about that maybe we need to rethink that, because when markets decline, when markets are in a declining phase and you're withdrawing money out of that, your break-even point is not 30 years, but it's actually about 12. So 10 to 20% decline in the market for a couple of years in a row could really make a difference. So if you're planning on having money through your 80s or 90s, by your early 70s, you could be broke. So this is the time for you, if you're at retirement, to really think, am I in the right place? Am I taking too much risk with my savings?
All right, so with all of this volatility,
Yes.
things are shifting.
Yes.
Right? So what does that mean for us? Interest rates going up?
Absolutely. And that's a fighting force right here, is that as rates go up, capital, funds move into bonds from stocks. So when interest rates are relatively low, people are in stocks because you get a higher rate of return. You have the risk for taking the investment is returned in the upward movement in the market. But when interest rates go up, people would much rather be in the safety of bonds, and so some of that capital shifts to bonds. The 10-year Treasury has moved from about 2.2% a few weeks ago to over 2.85% in that time period, which is an incredibly huge move. So keep an eye on interest rates. Everyone was alive in the 80s. We know that CDs are 18%. Everyone wants those CDs again. Maybe in our life we'll see it.
Yeah, so because we're changing from what we've had the last 10 years.
Absolutely.
Yeah.
This declining interest rate environment. And the thing about really everything in the world, it always changes. So it always goes to kind of the mean. So if you're away from the center for a long time, you can be sure that in the next cycle we're going to be moving back towards what the longer term averages were.
And you say if you're not managing your savings, you're going to lose. Right?
You could be in real trouble. We see people that come in every day from this show or from our workshops, and they have all their money in the stock market, and they don't even know that they do. And the market has been so good for so long that they don't realize they're really at risk. But if you're in your 60s or 70s and you have all the money in the market, you really need to be thinking about that.
So what are your top tips for retirees right now?
Number one, you got to have a written plan. You have to figure out all of your investments and sit down with your advisor and say, okay, all of my Social Security, all my pensions, all my investments, how can I generate an income stream? And when you're retired, you have a whole different philosophy. So when you're working, you're growing your assets. When you're retired, you got to protect those assets and make sure that cash flow goes for the rest of your life.
Right.
So sit down with your fiduciary approved advisor, have them review what you have, and make sure that you're not taking too much risk with your savings.
Yeah, you've got to avoid risk, right? You've got to
have
lower
to.
your risk. Now's not the time to be increasing your risk.
Well, because you could end up going back to work, and you may not want to do that.
No. All right, we want to take a break, and when we come back, David's going to answer your retirement questions. Don't go away. Welcome back to AM Northwest. David Swanson from Swanson Financial is here to answer your questions about the volatile stock market. So let's get right to them. These are viewer questions that have been sent to us. We met with our advisor last week as we're both retiring this year. He recommended that we stay the course. All of our savings are in the stock market. Should I be concerned?
So right off, I'd say get a second opinion.
Okay.
So I think that if you hear the same thing a couple times in a row, maybe you're okay, but that advice doesn't seem consistent with the environment that we're heading into. That would be the best thing for you.
Okay, and then I've always managed our retirement savings, but now that we are both near retirement, I realize I don't have a plan to create income. Can you help us?
Right. So the key that hopefully we've talked about this a lot is that you have to have a plan. You have to have a written plan. You have to calculate out what you're going to do in your retirement balanced against the resources that you have available. So you need to make sure that you're not going to run out of capital, and this is very, very important, is having this all planned out. So find somebody that you trust, sit down with them, and have them give you a plan to make sure you won't run out of money in retirement.
I'm curious, do you think there's going to be another drop like we saw 2 drops last week?
This volatility that we're having is really the beginning of more volatility that we're going to see. In any market top or any market change, we always have tremendous amount of investors going in and out of the market.
Oh.
So when a market is way up, people are taking profits. That's why they're selling to take profit. And the only way you can make a profit in the stock market if someone bought your stock at a price higher than what you paid for it, right? So if someone doesn't see the value, it's going to go down, all right? So intense volatility in a marketplace typically signals a change in the direction of the market.
Okay. Last week, the stock market really scared me. In one day, my account dropped by the whole amount of income I need each year. Wow. What would you recommend for someone like me?
Get a second opinion. I think that you're in too much stock. One of the gauges that we look at is that if you can't sleep at night with where your investments are, you got to make a change, okay?
Yeah.
If it doesn't bother you, don't worry about it. You've got to have enough income to do all of the things that you want to do. So make sure, whatever you do, that your accounts are set up so that you feel good. If you have an amount of money allocated into the stock market, and you say, okay, if I had this same amount of money, a check with this amount of money, would I buy these same investments right now? And the answer is, I wouldn't. You're not in the right place. You need to make some change.
Okay. Should I be concerned about rising interest rates and all of the market volatility of late?
Okay, so I've been doing this 30-some years. Stock market moves around a lot, but the bond market moves even faster. So when when interest rates move, if you own a bond mutual fund, what happens is interest rates go up, bond prices go down. That's just the dynamic of the world.
Right.
So if you own a bond mutual fund to try to be safer, the amount of money you're going to lose in a quick, fast rising interest rate environment will be much greater than what you would earn in additional income. So you got to be really, really, really careful about bond funds in a rising interest rate environment, because your principal will get sucked out and you think you're in safer, but you're really losing your money. And you can just look at the prices of these bond funds over a period of time, especially when interest rates rise, and see what they do.
And lastly, it says, I heard you have free workshops on maximizing a retirement income.
Yes, we do. We have workshops all over the city. Call our office if you'd like to come in for an appointment, and we'd be happy to give you a second opinion or attend one of our free workshops, and you'll get some valuable information to get you where you want to be.
If you're part of a partnership, husband and wife, spouse, wouldn't it be important for both of you to go to the workshop?
It really is, and when we put a plan together, we actually have separate questionnaires for each partner, because a plan is really a combination of the two, and one may think that something is really important and the other may think that something different is really important, and you've got to find a middle ground on that, because you will never come to an understanding if you're both going in opposite directions.
Right, all good points. We're going to put the information for you on Swanson Financial, 503-603-9900. Swanson Financial. We'll put it on KATU.com. Thank you, David.